tax record.
And Shankaran, you may want to repeat your disclaimer.
Okay. All right. Okay. Let me. Okay. So not only the disclaimer, but starting with the good morning wishes. Okay.
Yes.
Okay. So good morning and good evening to all of you. So I just titled this presentation "Living Off Investments Without Paying Taxes," primarily following what Ray Madoff in that wonderful podcast talked about. Okay. So she talks about how the American tax system is made, how rich people, save on taxes and pay very little, while the income classes end up paying quite a lot. So I'm not going to get into a whole lot of what she talked about. The one thing that made sense to me, and I thought I should look at this seriously, is how can I'm not a very rich person. I'm a poor professor, a retired professor that too. So whatever little investments I have, how can I live off that investment without having to pay taxes? So that's the whole idea. And Sonia Jain showed a lot of interest in the group. And I put a Excel spreadsheet to sort of think through this issue of how to avoid taxes legally. And that's how we are. So thank you for taking the time to come for this, and I hope I will learn as much as all of you, or even more. Okay, so this session is a discussion of the podcast by Ray Madoff. She's a law professor in Boston, and if you've not spent time listening to this podcast, I would seriously suggest you do so. Okay. All right. Having said that, here are some of my disclaimers. This is only a discussion of the podcast. There are no recommendations that I'm making here, no suggestions that I'm making. Okay. Oops. Okay. And she's talking about these rich people taking loan against their investment, which is constantly, greened out or greened in. So I'm not recommending that you take any loans while investing. Okay. And the Excel sheet that I'm going to present is only to illustrate the idea that Ray Madoff is talking about. I'm not a certified or licensed tax or investment consultant, and what I'm saying here is not to be treated as advice. If you do whatever we talk about here, it's entirely your own. Okay. So having said all these disclaimers, let me start. So this is just an assumption. Forget the number for a minute. What she's talking about is the rich people have investments. How they got those investments is another matter. Maybe because they started a company and their sweat equity became, pretty valuable now. But the rich ones, the very rich ones, the stinky rich ones, have billions of dollars which they have accumulated because of whatever wealth they created for others. So you have an investment value, and I'm putting that for my sake. 2 million. I don't have 2 million. I just put 2 million because I assumed that most people in the United States who perhaps come to retirement age would have at least 2 million in their account, whether it's in the brokerage individual account or in your IRA. Okay. And it's a nice number for me to illustrate what I'm going to talk about. So I just took 2 million. And the portfolio grows at a particular rate every year. And as some of you mentioned in the group, some years may be washed out, negative growth or no growth at all. So year after year, we cannot assume that the portfolio will grow. But overall, the market has shown over the last 40, 50 years that the market starts from the left bottom and goes to the right top. It is constantly growing at a particular rate. So whichever index you follow, you will see that over a long period of time, there's at least a 15% growth in the US market. Now, I took today's interest rate on the loan, and a home equity line of credit is 7% per year. Okay. And so I've taken that. And I'm saying if you take a loan on investments, not more than 5% of the portfolio value, which means in this case $100,000, is the loan would someone might take, and this loan is returned with interest every year from the growth in the investment, and a new loan is taken for the following year. So that means every year. Oops, sorry, I keep. Okay, every year, whatever money you require for your annual living expenses, there is a loan to cover that. Again, as I said earlier, I am not recommending you take a loan, but this is how Ray Madoff is presented. Okay, so these assumptions are primarily to illustrate this discussion, and I'll soon bring up the Excel sheet and show you as well. Okay, so how is tax avoided? According to her, the rich people take a loan from the bank at the beginning of the year, use the loan amount through the year for the living expenses, and at the end of the year, withdraw from investments to repay the loan or keep renewing the loan. Okay. And when you withdraw the investments, no tax is payable if you can avoid capital gains. Then the question is, how do you avoid capital gains when you withdraw from the investment? Okay. So if I have to withdraw from my investment to repay the loan every year, I need to do that without capital gains so that I don't pay taxes. That's the whole idea of Ray Madoff, that we don't pay taxes on investment gains. Okay, so any portfolio, if managed properly, will grow every year. Now, how do you manage that to keep growing every year? That's a different matter altogether. I'll be happy to talk to you individually if you are interested, okay, where I'll share my experience. Several of you here have taken my courses on fundamental and technical analysis, where I do talk about my experience in growing my portfolio, okay? So that's a different matter. But any portfolio, if managed properly, will grow every year, in spite of ups and downs in the market. Okay, so a portfolio is made up of stocks. So you will see gains in certain stocks and losses in some. That is natural. It's very difficult to perhaps invest in all the stocks where you will end up making gains, which may happen, but it's difficult. So increase in the value of investment includes your realized gain that you might realize if you do buy and sell, and you'll have realized losses as well because you buy and sell. Sometimes you will sell at a loss so that you can reinvest that money in profitable stocks. At any point in time, there will be unrealized gain and unrealized loss as well. Some stocks will have unrealized gain, some stocks will have unrealized loss. Okay. So given this nature of your portfolio, you sell stocks that have unrealized loss so that will have no capital gain. The question is, what percentage of the portfolio will have such loss to cover the loan that you have taken for your living expenses? Okay. So that comes, sometimes, you'll be so good in managing your portfolio, you may not have losses at all, in which case, I guess you just have to pay taxes. But if you do have losses, we have to harvest, okay? So if you do have some stocks with losses, you harvest your loss so that you can avoid the taxes. This is the simple thing. The key is to manage your portfolio, not individual stocks. I know a lot of discussion in the group has been about individual stocks and not necessarily the whole portfolio. Some posts by Mohan have talked about managing the portfolio, but the bulk of the discussion is on individual stocks. So I hope you all look at your portfolio as well, not just individual stocks. And I said there will be stocks in your portfolio that will be in loss, so you can harvest your losses, just like you may harvest your gains. But even if you do not harvest your gains, do harvest your losses so that you can use the investment that had the loss to avoid paying the taxes and to repay the loan if you do take the loan. Okay, so now what I'm going to do is to switch to the Excel sheet where I'll show you these numbers. Okay, any questions so far before I go to the Excel sheet?
Yeah,
Okay.
I mean, Sankaran,
Yes,
just a
please.
quick question.
Yes.
Instead of taking a loan on the portfolio and then paying 7.5%, but
Yes.
what if I just do exactly the same thing, right? Balance the losses with my profits so that
Yes.
I do not pay
Yes.
big capital gains. I could also do that, right? Or what's the difference between these?
Absolutely. As I said, I'm not recommending that you take a loan.
Okay,
This is what Ray Madoff talked about in our podcast. Okay,
gotcha.
but you're absolutely right. In the first year, let's say you just tightly manage yourself. Don't take a loan. As and when you harvest losses, you take that money while your portfolio keeps growing. That's perfectly fine. So in the first year, you live very tightly. Okay. And from the second year, things become very good for you because whatever gains whatever investment you sold off and to avoid taxes, you'll use that cash from the second year beginning onwards. You're absolutely right.
Okay.
Not
Thank
everyone would have the mindset to live with a loan. I know several who just hate loans. Okay, so you're perfectly fine. You don't need to take a loan. Okay, if you manage in the first year, that first year whatever you harvest will help you through the second year and so on. Okay, you're right. Any other questions?
Yes, Shanks, I have a question.
Yes.
Is Ray Madoff talking about pledging your stocks, that is, using that as a collateral, taking a loan?
Yes, that is what she's talking about. The rich people will be able to swing the banks their way to the extent that the banks will give them a low interest loan because they are stinking rich. Okay. Yes.
Okay.
But for the rest,
And they talk about how banks are in the business of giving loans. They can't just keep cash and wait. They need to give loans. That's their business, and they need customers who are wealthy enough that they are not going to take the loan and run away. So they say it works both ways wonderfully because the rich people have so much money and they want to take a loan to handle this, tax avoidance. And the banks have a lot of money, much more than what these rich people have, so that they can give it to those rich people and make some interest income. So that's their business. So
So my second question is, besides tax loss harvesting, is there any provision for the interest payable on the loan? Is there a tax reduction or write-off for that?
sorry, I do not know. Okay, and she doesn't talk about that in the podcast.
yeah, the margin loans, yes, you can take off in your taxes. Whatever you pay as margin,
Uh-huh.
that you can take.
Okay.
Yeah.
I can tell you, my tax accountant does not write off the margin interest. Okay. So sometimes I do end up using a margin in my account, and I every year end I give him the statement with the margin interest, and he doesn't use it. But maybe you're right. I don't know.
Margin
I
is-
haven't
have you
pushed
done-
him.
No, the difference is the standard deduction and itemized deduction. That's what the difference is.
Oh, I see. Okay, very good. I see Sonia Jain raise her hand. Yes,
Oh,
please.
yes. Hi there. Good evening.
Good evening.
Thank you for doing this.
Sure.
So, after I listened to the podcast, which you
Mhm.
kindly forwarded,
Mhm.
I did delve into this a little bit deeper. So,
Mhm.
if are you okay if I took the last question of whether the interest can be written off?
Mhm.
Um, it can. So it depends on what you use the money for. So
Okay.
if you took say what the pledged asset line is called the security backed line of credit. So I
Mhm.
called my bank and asked them.
Okay. Thank you.
So depending on how much wealth you own, whether
Mm.
it's $1 million or $2 million or $5 million or $10 million,
Mhm.
actually that interest rate can be very nicely negotiated. So the more you own, the lower interest rate they will give you. So frequently the interest rate you get on your security-backed line of credit is a lot lower than your HELOC or the home equity line of credit. So it can be as low as 4 or 5%, depending on what you have. So of course, for the likes of Bezos and stuff, they are literally getting the loan at less than 2% because of they have billions of dollars. So that's one. So if you use the money that you take, the reason to take the money is, say you took $300,000. That $300,000 is very different from your income. So if you earn an income of $300,000, you pay whatever taxes, say 25%. But if you took a security-backed line of credit, you get $300,000 in your bank account in 2 or 3 days, and there is no tax charged on that. So you can utilize it for the entire year, 2 years, 3 years. You're not paying any tax. So that's the genius of taking this loan. So if you took the money then and you paid it towards, say, a down payment or business costs. So if you used it, if you have an LLC or you're a business owner and you use it for business costs, repairing something, replacing machinery, etc., the entire interest can be written off against the business. The one thing you cannot do when you take these loans is treat it as a margin loan. So for a margin loan, the interest rate is frequently higher than any of these lines, but you cannot take $300,000 and go and buy stocks with it. That is very closely watched and tracked. So the IRS watches that, the banks have to report that, then they don't like it. But what a lot of people do is, so they'll take the $300,000, they will use that to pay their bills. So you can use it to pay your home mortgage, you can use it to buy a car, your car payments, your grocery bills, etc. But then you take your earned income of $300,000 or less and you divert everything to buy stocks. So you've essentially got a 0% tax extra income, which can match your current income. And so in the long run, you then come out ahead. And so if you use that to write off your loan interest as well, then you've just got all that money and the growth for free. So I hope that makes sense. And this is what Robert Kiyosaki, he did too. So you can keep doing that even on your real estate. So if you
the rich
have
dad, poor dad.
that is
That's the
correct.
author.
So that is that
Okay.
I forget what it's called, the 1039 or whatever conversion. So you can use the money, you can get a loan against your investment property, and then you can use that loan to buy a second investment property and go on that way. So that's what I found out after I listened to the podcast from the bank.
Thank you so much. You have done a lot more research than I have. But this is really, really helpful for whoever wants to take this forward. Excellent. Thank you.
I have a question, just a clarification.
Yes.
You're saying like how we can take a loan. Let's take I have a home loan or my rental property loan for 6%. So if these people are giving a loan like the example shown here, I take $100,000 loan, and I don't get charged as an income on that. But what is the interest they ask us to pay? If it's going to be less than 6%, it's a win, right? I can just use it to pay off my rental property loan.
Yes, and that's how it is meant to be used. That's how the wealthy, and honestly, it sounds like you don't have to be all that wealthy to use it. Apparently, a lot of people use it. People, like a lot of realtors use it. They buy it to flip a property and buy it. They don't need to have millions of dollars, but this is how they keep their money growing.
Okay. So thank you. Here is the Excel sheet that I put together to illustrate this computation. So I'm starting with a stock value of 2 million, and assuming the loan is just about 5% of that 2 million. So that's 100,000 in. Hey, can you mute, please? And that's 100,000 that you get upfront as a loan. And I'm assuming a 12% increase in the investments. But as you see here, in row 10, every year the growth in the investment might be different. It could be 0 one year, it could be even minus. So I've just put that to see the what ifs. Okay, the interest rate I've considered the home equity line of credit as 7, but as Sonia said, it could be as low as 2% if you are able to work that out. And if you do that, you see here, you start with the 2 million and the loan is 100,000. So the loan with the interest at the end of the year is 107,000. Okay, which is only 5.35% of your overall portfolio. And at the end of the year, your portfolio has grown from 2 million to 2.24. Can you mute, please?
இந்த குடும்பம்லாம் வந்து சொல்லுவாங்கல்ல, என்ன எப்போ பார்த்தாலும் அவங்க கூட டைம் ரொம்ப ஸ்பெண்ட் பண்ற, எனக்கு கூட நீ டைம் தர மாட்டேன் அந்த மாதிரி.
Oh my goodness. Can you please mute? Okay. So this 2.2 million, in the beginning of the next year, having repaid this 107,000 becomes 2.133 million, which again grows. So you can simulate this. I'll share this Excel sheet in the group. And you see, even in a year when there is 0%, okay, your portfolio is not suffering that much, and you can continue to get your 100,000 plus loan on a 2 million initial portfolio. And you see here on a minus 6% on a year, it has come down, but you can still keep getting your lifestyle managed with 100,000. Okay. So this is what triggered off our discussion and this seminar. So I've learned now from whatever Sonia had researched and presented. Thank you so much. Any other question?
So Sonia, you're saying like what is the maximum we can get? 5% of the corpus of the.
No,
No,
that
you
5%
can,
is something I put. Okay, that's not
right.
what she said. I just put 5%. Okay.
But usually what they give, like margins are different rates based upon your volatility of the stock or the ETF. But is this given based upon that, similar to margin, or is it a different algorithm used for giving?
It is similar. Basically your stocks are your guarantee or your home is your guarantee. So it really depends how much you have. They will give up to, depending on the client relationship, up to 60%, but typically 50%. Of course, you don't want to do that. You don't want to take 50% because if there's a market sharp downturn like 2008, you will have to sell. So that's what Sankaran is saying, that you don't keep it really low. And I think for people like us who are retail investors, I think the wisdom is following Sankaran's advice to keep it low if you're going to dabble.
And the interest rate you said was up to 2%?
That is if you have a super large portfolio. If your portfolio currently, it really depends. Of course, the bank guy was talking about different things. So he said if it's a 15 plus million portfolio, they will go between 2 to 4%. So basically, there is just like your home loan, right? There is a basic line, there is a basic interest rate, and then the bank will deduct a certain percentage depending on your portfolio relationship. So they can deduct as much as 2% or 1% or 0.5% or 0.75%. And then you can negotiate with the bank. You can say, reportedly, you can say, hey, look, I have two brokerage accounts. So I have a certain amount of money here. If I brought in money from elsewhere, which they want to do, then they will say, okay, we will lower it by another 0.5%. The long and short of it is not a fixed rate, and you can really negotiate it much better than you can negotiate a mortgage loan.
So this is something you go to the bank, not your mortgage, not your brokerage company, and go to the bank, and you show them your brokerage accounts, and then they in turn give the loan based on that.
No, the other way around. You go to so if you are with Morgan Stanley or Schwab, you will go to your your advisor in that account, and they will give you the money. They will create a checking account for you and transfer the money to you. So the loan is through the brokerage account.
Brokerage account, but they keep this as collateral, right? They somehow link that money like a margin. They will get this, but not treated like
the easy way to think about it is it's exactly like a margin, but only they're giving you money up front.
Yeah, but only thing, you cannot use it to buy stocks. You have to use it to buy other things.
Correct. If you use it to buy stocks, you can get into a lot of trouble.
Okay. As long as we can use it for other things. Okay, cool.
Wonderful.
But it is not.
I believe you are giving a right
also
to them to sell it off if it is something goes bad, I believe, right? That's what in margin loans happen. So it could be the same scenario here. If suppose my portfolio down very excessively low, then they can sell that portfolio. So you are giving a right. Is that right? Right to sell.
But that's only if you have 5%, they can't touch your money, right? Like if you have 5% of your portfolio is the loan, it's a very small percentage. So they can't really sell it. But if you have 50%, so it's a math thing. So if they say you have to maintain at least 50% of the value of the portfolio, right? So if suddenly your portfolio itself drops from 10 to 5, then you have too much loan and they have to sell it. So that's why you buffer it by having a really low percentage as a loan. Which if I do it, that's what I would do. I am just dabbling in it. I don't know enough. But what I know, I would like to explore with a very small amount.
Yeah. So as Ganeshan was saying earlier, if you don't take a loan, first year you pretty much work with your own portfolio, and you make this 2 million 2.24. So you see how you can make your 12% or whatever rate that you can get in the first year in your investment. And from then on, first year you will end up paying taxes, and after that you keep rolling. So from the second year, you implement the strategy of taking the losses, harvesting it, and so on. Okay, so that is also possible. But thanks to Sonia, we have a lot more information about the security-backed loan that the rich guys get it. Okay, all right. There are people who came in a bit late. I am recording this, so I'll post the video in the group, the YouTube. I'll put it on YouTube and put it in the group. Okay.
So the first year, can you clarify? You mean like after that you loan yourself, like you make the money in the first year, pay the taxes.
Yeah. So
then
from the second year onwards, from the second year onwards, whatever you're harvesting right now, that's what I've done. Let's say in my portfolio now in the last 4 months, my portfolio has grown, let's say $100,000. Okay. So what I did now, this particular month especially, I got the opportunity where my portfolio has grown 100,000 already. Okay. So I looked at my portfolio and said, which are the stocks that are in loss? Okay. I work only with X number of stocks. I don't have more than 10, 12, 15 stocks in my portfolio. And these are the stocks that I will keep investing till something changes in my view of that portfolio. Okay. To give you an example, yesterday in the group, a few stocks were presented. But I don't have it, and I don't intend getting into those counters, even though they look very attractive for now. Only when my next review, I've done my back testing and I know that these stocks are what I want, I will not change my portfolio. Because my current portfolio, I've already back tested. I know how much I can make if the same past works in the future in terms of technicals. So I am comfortable buying and selling those stocks in that portfolio, the 12 of them. Okay. So what I did now is I looked at some of them. Obviously, at any point in time, even though they're very good stocks, there are times when there will be an unrealized loss. So I booked those losses. So out of 100,000, my portfolio has grown already from the beginning of the year. Okay. What I did, about 80,000, I've already booked off without affecting the portfolio value. Okay. So my portfolio value still remains the same. I had the opportunity to book losses and bring it into cash. So, like that, in the first year, without taking a loan, I will do this harvesting. So, from the second year, whatever I have harvested in the first year helps me to maintain a particular lifestyle. That's all.
Okay.
And Shankaran, would you do the harvesting based on technicals and the signals that you get at any point during the year, or do it, let's say, in the last quarter of the year?
No. I am buying and selling right through the year, depending on when the technicals allow me to do it.
Okay, so you'll, whenever you get a chance to harvest losses, so you actually look forward to losses.
No. It's, while I harvest losses, I am also harvesting gains. Okay.
Okay.
Yeah, so it's not that I don't harvest gain, because if the selling signal is there, I will sell, and that means there will be a gain at that time, and I book that gain. But I also book losses. But I'm not.
So,
One second. I'm not deliberately looking to make more losses than gains. Okay. It is the nature of the portfolio. It's the nature of the stocks that there will be losses sometimes. But overall, my portfolio is growing. Okay. That's what I'm saying. This last 4 months now. Okay. Given the situation especially in the last 3 weeks, my portfolio is now grown. So I have $100,000 growth in my portfolio. But I don't have to worry about having to pay that. Let's say today, if I have to pay for the first quarter, I don't need to pay, because I manage the losses in such a way. So my portfolio value has gone up, but I don't have capital gains to pay taxes.
Great.
So, usually I time it in October first week, because usually the harvesting takes place from December 15th. So if you go then, you are going to be along with other people, because basically the ones which has big losses, people will come out of it. People try to trim it off. Like when they see their portfolio, they don't want to pay taxes. So the harvest season of the loss harvesting takes the last 2 to 3 weeks. So if you want to do it, start October 1st week onwards, so that you are slightly ahead of them. Otherwise, you will be the losses will be more on the ones that are trying to come out.
Yes.
So, and then other thing is, you want to allow the stock, you think it's going to come back. It's been some reason, it's been under for some other reason, fundamentals are strong. You probably do it, sell it in October, try to buy it in January. That way you don't wash sale. In case you.
Good point. Thank you. Yes.
Okay. Any other comments, please? Okay. If you don't have any, okay. So this is the takeaway for me, that we need to manage our portfolio, not individual stocks alone. And there will be stocks that will be in loss, so we can harvest the losses. So nothing to be afraid of losses. Losses can be helpful for us. So we look at them strategically. Okay. And if you need to reach out to me, here are my contact details. Pariksh.com is the backtesting software site. You're welcome to use it. It's right now free. Backtest your strategy, backtest your individual stock strategy or a portfolio stock strategy, and then go ahead and implement that strategy. Okay, so you're welcome to use it. Give me feedback on this software portal whenever you can. We'll keep improving it for you. Again, thanks a lot for joining.
Shankaran.
Yes.
Sorry to stop you here, interrupt. If you can quickly go to Pariksh, and other than back testing, is there anything else that can you quickly show it to us?
Nathan, did you have any question?
Yeah, I just wanted to know. I mean, obviously, I know that you have a US portfolio and an India portfolio.
Yeah.
And so, are these techniques something that you have applied to the India side as well, or you are just focusing this on what is possible?
Okay, on India, the loan interest rates are very different, so I would not do the loan strategy there. Okay.
Mm-hmm.
Unless you're very, very, very rich and connected, you don't get such low interest loans. So for the average investor, I would not do this in India, except that I manage the loss harvesting strategy. There's nothing like wash sale in India, so that's a good thing. In America, if you sell something, book a loss, and within a month of that you buy, either before or after, that is not considered for your tax purposes. Whereas that is not the case in India. So there are good things about India that we can use for this purpose. Okay, that you can sell today and 2 days later buy back the same stock. The portfolio will still be the same, but you would have booked your losses. That is possible in India. That's a good thing. Okay, so I would do only portfolio management based tax savings in India, not by taking a loan. Okay.
All right, that is useful.
Yeah, thank you. Let me see.
So, Shankaran, how can we avoid the wash sale?
How can I avoid? That's what Dr. Vijay spoke about. No,
I just posted now.
Yeah, he said start from October, and if you have a portfolio, okay, let's say 10 or 15 stocks, when you sell one, there'll always be opportunity to invest that money in the other, which is going to keep growing. So you can manage. Okay.
Yeah,
so
I
you
just
mean we
posted.
cannot buy the same stock within 30 days gap?
Yeah, so I posted that one in the chat. Like avoid almost like make it 60 days. Then it depends to avoid the word sale.
Yeah.
But if you have so much of your liking for that particular stock and you think it's got beaten up, you can always buy. Usually, you do it in October timeframe because as you see, I just took it from the Gemini. You don't want to wait till December because that's where it will be crowded year-end sale. Rush will happen. So.
Okay, but I became the victim of the same wash sale in 2020, 2021. But I think is there something like we call the mark-to-mark election?
No, wash sale, when you sell the entire stock right at the end, you will get your wash sale back. Like when you're going to clear your entire see, the wash sale comes in only when you bought stock again or a month prior to that one, right? Then it's where it comes. But when you go back and sell the entire instrument, right, or the entire, like let's say you have an ETF or you're going to have like NVIDIA. So you bought and then you took a loss and then you bought again within 30 days. Yes, it'll be a watch sale. But when you're selling that one, the watch sale will get added to that.
Correct. So you're only postponing the whole process into the next year. Okay. A watch sale doesn't mean you're not eligible to write off this. It gets adjusted. So the thing moves from this tax year to the next tax year. That's all.
Okay. But in a taxation, is there any 475F form or something we can change it the taxation method, which we call the mark-to-mark election, so we can completely avoid the wash sale?
Oh, you're getting too technical.
So far, my tax advisors have not recommended anything. They just asked me to whatever the watch sale comes in the brokerage account, they probably will use only that. So they have not circumvented the watch sale part. So.
Actually, my way of handling this is I don't necessarily worry about watch sale. To me, making money is more important than having to pay taxes. And anyway, if I can avoid taxes legally, I don't really worry about watch sale. Okay, because I want to keep it simple. And so I say, okay, I don't need to micromanage too much to handle the wash sale business. Focus on growing your portfolio. To me, that is more important. And if it so happens that there is a wash sale, so be it. Doesn't matter. Okay, because it's not that I lose. I don't get to use it this year. I can use it the following year. That's all. Okay. Okay, so this is Pariksh.com. You're welcome to use this. We have back testing for individual stocks here. Okay, but now I have not put it here, but we also have the feature to backtest your entire strategy, which means even your allocation across stocks in a portfolio can be tested out.
That's the first link, the clinic to.
Okay, all right. Sorry, thanks, Madhu. Yes, so you can go to clinic.pariksh.com and you can put an entire portfolio here. Okay, you can put an entire portfolio and do the allocation per stock. In this case, we have assumed equal allocation. You can look at time frame. You can look at if you want to withdraw every month, you can do that. Again, in this particular software, we have not done the tax saving part that we have kept for our individual use internally. Okay, and then you can put your capital gains tax and check it out. Okay, so feel free to use it. Give me feedback so I can improve this. So right now it's free of charge. You can use it as long as you want it. Okay. So thanks, Valmiki, for reminding me to show this. Yeah. Yeah. So I have my courses listed here, so you're welcome to join my courses if you want. These are paid courses, so whenever you feel like, okay. Madhu, I'm not able to go back, huh? Okay, all right. So I think the link is not working. There you go. Okay, there you go. Okay.
Yeah. Okay.
So thanks again. So can I stop? You have any comments, questions?
Thank you, Stan. Thank you very much for sharing.
Yes.
Yeah, for sharing.
Thank
Okay.
you so much.
Yeah, thank you, Sonia.
And
We have
thank you,
done a
Sonia.
lot
That
of
was excellent
research.
input.
Yeah.
Yeah. Thanks for
Thank
all
you,
the
Bharat.
good inputs. Yeah.
Yeah, my pleasure. Thank you.
Yeah. Bye.
Bye.
Have a wonderful evening. It's election day in India, so I'll watch some fun here. Okay. Bye.
Okay. Yeah. You should.
Yeah.
Yes. Bye.
Yeah. How do I stop the recording here? And
Prof, can I call you for a minute?
yes, please.
I'll drop
You
off
do
and
that.
call you.
Yeah. You call me. Yeah, please.
Okay.